Good day, everyone. I'm Avery McLean, and today I'll be discussing how sensitivity analysis is used as a tool for capital budgeting. This session will explore how financial managers assess risk and uncertainty when deciding whether an investment is worth pursuing. By the end, you'll understand how both quantitative and qualitative factors help determine which projects create real value for a company. The goal of financial management is to maximize the value of the firm and ultimately shareholder wealth. To do that, managers must carefully balance liquidity, profitability, and long-term growth. They oversee the company's capital structure, choosing the right mix of debt and equity, and allocate funds efficiently across competing projects. Essentially, financial management ensures that every decision, from operations to investments, supports sustainable financial stability and value creation. Sensitivity analysis is a method used to understand how different assumptions impact a project's outcome. In capital budgeting, it answers the question, what happens to our results if something changes? For example, if material costs increase or sales decline, how will that affect our net present value or internal rate of return? By testing these variations, we identify which assumptions are most critical and which risks deserve closer attention or contingency planning. Before we dive into the actual numbers, let's take a second to define a few key terms. First, net present value, or NPV, is basically how we figure out whether a project makes money once we factor in the time value of money. In plain terms, it compares what we're going to make in the future to what we're spending today. If that number, the NPV, is positive, the project's adding value. If it's negative, we're losing money. Next, cash flow, or CF, just means the real cash coming in and going out of the business. It's not accounting profit, it's actually money movement. It's what fuels our NPV and IRR calculations. Then there's IRR, or internal rate of return. That's the discount rate that makes our NPV equal to zero. Basically, the project's break-even point. If our IRR is higher than the cost of capital, it's good to go. Now, let's walk through how we actually do a sensitivity analysis. Step 1. We start with the best case scenario. That means we plug in our best, most realistic estimates for sales, cost, and the discount rate to calculate our expected NPV. Step 2. We identify the key variables that really drive the outcome. Things like sales, volume, costs, and the discount rate. Step 3. We change one variable at a time, up or down, while keeping the others constant. Step 4. We recalculate the NPV or IRR after each change. In step 5, we compare the results to see which variable makes the biggest impact. That tells us where our real risks are. While the math gives us clarity, qualitative factors add context. Management's experience, adaptability, and leadership can determine whether a project succeeds despite changing conditions. Industry trends, government regulations, and consumer sentiment all play major roles too. For instance, even with strong NPV numbers, poor leadership, or an unstable market can derail a promising venture. So, we pair data with judgment to capture the full picture. Internally, we use several tools to manage risk. Scenario and simulation analysis let us test multiple what-if combinations, while break-even analysis tells us the sales level needed to cover costs. We also apply risk-adjusted discount rates to reflect uncertainty directly in the NPV calculation. Finally, cost of capital evaluations ensure the project's returns exceed its financing cost. These methods rely on internal data and assumptions unique to our organization. External analysis looks beyond the company. We assess market trends, competitive performance, and economic forecasts like interest rates and inflation. We also consider supplier reliability and the broader business cycle. This outside perspective prevents us from operating in a bubble and helps ensure our projections remain grounded in real-world conditions. Once the analysis is complete, we combine both the quantitative results and qualitative insights to make informed decisions. We focus on the variables with the highest sensitivity and incorporate risk-adjusted metrics such as NPV, IRR, and payback periods. This helps management refine the project, create contingency plans, or even reject the proposal if the risks outweigh potential returns. Ultimately, integrating risk ensures that each capital investment supports sustainable growth and aligns with long-term financial strategy. To sum it all up, sensitivity analysis helps decision makers test their assumptions before committing to major investments. It reveals where the biggest risks and opportunities lie, and ensures capital budgeting decisions are based on both data and sound judgment. Thank you for your time and attention. It is greatly appreciated. The insight and frameworks discussed in this presentation are drawn from the following references: